China's economic growth has been sluggish, and the main reason is the decline in the capital accumulation rate. The biggest factor causing this decline is capital flight. How much money has left the country? I can confidently say it's no less than $3 million.
Recently, Chinese economist Liu Qiyuan stated in an independent social media video that China has experienced capital flight of no less than $3 trillion, equivalent to 21 trillion yuan. This amount is comparable to China's annual fiscal revenue being taken away. Although Liu did not reveal specific sources for these figures, the fact of capital flight from China is indisputable. Corrupt officials and wealthy individuals fleeing with large sums of money have long been a notable phenomenon in China. Capital flight includes not only funds taken by fleeing officials and emigrating tycoons, but also recent withdrawals of foreign capital and outflows through stock and bond markets. High-level corruption scandals within the Chinese Communist Party, or CCP, have been exposed internationally. The 2016 Panama Papers scandal revealed evidence of several prominent CCP families using offshore companies to hide substantial assets. It is rumored that the previous president, Jiang Zemin's family, holds $500 billion in overseas assets, managed by his grandson, Jiang Zhicheng. Veteran journalist Bill Gertz, with close ties to the U.S. military, wrote in the Washington Times that U.S. intelligence agencies are investigating the 7 members of the CCP Politburo Standing Committee. A report on the wealth and corrupt activities of the Chinese Communist Party leadership is being prepared, targeting Xi Jinping and other senior CCP officials. The investigation also includes a 205-member Central Committee, 25 Politburo members, Politburo Standing Committee members, and 29 provincial party secretaries. The report is expected to be completed by December 22nd of this year and will expose widespread corruption and hidden wealth among CCP leaders. According to the Institute of International Finance, Chinese stocks and bonds have seen cross-border capital outflows for 5 consecutive quarters, the longest period on record. In the third quarter of 2023, China's net foreign direct investment turned negative for the first time since data collection began 25 years ago. Massive capital outflows have previously triggered financial crises in Latin America, Southeast Asia, and China in late 2015 and early 2016. While the total scale of capital outflows from China remains debated, some believe the country's ambiguous international balance of payments data obscures outflows of up to $500 billion. Chinese experts suggest that the speed of capital outflows may not pose an imminent risk to China's $17 trillion economy, largely due to strong exports of many key manufactured goods, providing stable cash flow. The outflows are roughly equivalent to the funds brought in by China's substantial trade surplus. The CCP has leveraged China's demographic dividend and the population's propensity to save, exploited labor, and heavily subsidized exports to disrupt Western free markets. Despite the CCP's claims of grandeur, the problem of escalating capital flight remains unaddressed. To date, the Chinese government asserts that the situation is under control. The outflow of funds from China has weakened the yuan against the dollar and other currencies. A weaker yuan helps sustain China's exports, which supports millions of jobs. However, the discrepancy between China's trade surplus and the growth in foreign exchange reserves has persisted for more than a couple of months. In 2023, online discussions highlighted similar concerns. One comment said, "In the past 3 years, our country's goods trade surplus totaled nearly $2 trillion, but foreign exchange reserves have remained almost unchanged. Where did the over $2 trillion in foreign exchange reserves go? China's current foreign exchange reserves of over $3 trillion are $1 trillion less than a decade ago, despite consistently large annual trade surpluses. Where has the hard-earned foreign exchange of the people gone?" In a November 2023, the New York Times published an article titled "Gold Bars and Tokyo Apartments: How Money is Flowing Out of China." The article highlighted that Chinese buyers have become the main purchasers of apartments costing over $3 million in Tokyo, often paying with boxes of cash. Additionally, Hong Kong insurance has been a channel for Chinese citizens to acquire overseas assets, with new business policies for mainland visitors in the Hong Kong insurance industry soaring nearly 27-fold in the first quarter of 2023, reaching an astonishing 96 trillion Hong Kong dollars. The flight of corrupt officials and state-owned enterprise criminals from China began in the late 1980s. In 1991, the term plotting to abscond with funds was officially used in the Supreme People's Procurator's work report. In June 2008, the People's Bank of China cited a report from the Chinese Academy of Social Sciences revealing that since the mid-1990s, up to 18,000 officials had fled abroad, taking with them an estimated 800 billion yuan, or 112 billion US dollars. The report also noted that from 1995 to 2005, as many as 1.18 million naked officials whose families had moved abroad while they remained in China were still holding official positions. China has strict foreign exchange controls, so how do the wealthy manage to live well abroad? The most common method is money laundering through underground banks and the establishment of offshore family trusts. An even larger amount comes from cryptocurrency trading, which is currently the most popular method, allowing even the middle class to get rich overnight. Let's discuss these methods one by one. Regarding money laundering through underground banks, China has strict foreign exchange controls, allowing each person to transfer only $50,000 annually. Transferring $30 billion would require at least 600,000 people. Therefore, the money is transferred through underground banks, the largest of which are based in Hong Kong. There are about 1,200 underground banks in Hong Kong, specializing in transferring assets for the wealthy, charging a transfer fee of only 1 million Hong Kong dollars, which is just slightly more than bank fees. This explains Hong Kong's prosperity and strong industrial chain. A media outlet once interviewed a Hong Kong businessman involved in this trade. He worked with a European investment bank to help wealthy individuals transfer assets. In less than a year, he moved $150 million and earned $770 in commissions. The Hong Kong businessman revealed that he asked the wealthy to transfer money to an account in a European bank's branch in China, then froze the funds. Once the wealthy individuals received the equivalent amount in Hong Kong dollars, the funds were transferred to the investment bank. In this process, both the investment bank and the broker earned commissions. Another method involves underground banks setting up offshore shell companies, pretending to have business dealings with clients, and using these dealings to transfer funds. This method handles large transactions, such as obtaining export trade rights and falsifying customs data to pretend to do business with shell companies. A few years ago, authorities in Guangdong busted underground banks involved in moving $140 billion in a single year. In May 2005, the Legal Evening News reported that the Ministry of Commerce revealed the inner workings of capital flight, with 4,000 corrupt officials taking $50 billion. Many major cases involved offshore financial trusts. What is an offshore family trust? It is a way for wealthy Chinese to manage or dispose of family assets through investment trusts, effectively holding company shares through foreign trusts. A report revealed that 10 wealthy Chinese individuals with offshore family trusts transferred $77.4 billion. These individuals include influential figures like Alibaba's Jack Ma. In 2018, at least 20 controlling shareholders of Hong Kong-listed companies set up or transferred shares to offshore family trusts, including 15 mainland companies with shares worth about $28.5 billion. At the end of 2018, 4 tycoons, including Soon Hong Bin of Sunac, transferred shares worth about 116.6 billion yuan, or 16.3 billion US dollars, to offshore family trusts. In the last 2 months of the previous year alone, mainland clients established over 300 overseas family trusts. An analysis of 10 wealthy mainlanders, including Jack Ma, JD.com's Liu Qingdong, Sun Hongbin, and CEO of Xiaomi, Lei Jun, show that these 10 individuals alone had transferred assets worth 500 billion yuan, or $70 billion, into family trusts. Jack Ma holds Alibaba shares mostly through overseas entities, with only 0.2% held personally, and the remaining 99.8% held through offshore family trusts, overseas charitable foundations, and Cayman holding companies, with a total value exceeding 170 billion yuan, or $23.8 billion. Next is movement of funds through crypto investments. The Chinese government could potentially trace the flow of wealth transferred by the rich if they thoroughly investigated, but laws often lag behind the methods used for transferring wealth. Advanced technology such as blockchain and cryptocurrency investments allows Chinese investors to circumvent foreign exchange controls due to the anonymity and traceability of cryptocurrencies. Why is cryptocurrency now the most popular method for money laundering? It's easier than setting up offshore family trusts or subsidiaries. For instance, a man from Shandong became a billionaire by trading Bitcoin. In 2018, he sold 500 Bitcoins in the U.S. and used the proceeds to buy a 2,000-meter-square luxury mansion in California and a Rolls-Royce. Other methods of transferring funds include buying overseas assets, real estate, and art. With China's foreign exchange restrictions, how do the wealthy buy houses in the U.S.? Many wealthy individuals are business owners who can transfer large sums of money overseas by fabricating procurement funds through their companies. One method involves using domestic companies to secure loans from domestic banks by pledging domestic assets as collateral. This allows the subsidiary overseas to obtain loans, which are then used to invest in overseas real estate. Another technique involves playing with company names. To transfer funds, companies are set up overseas with the same name as their domestic counterpart. For example, a company established in the UK with the same name can receive funds transferred from Hong Kong banks, making it difficult for the banks to distinguish between the Chinese and British companies. Once the funds reach Hong Kong, they can easily be transferred overseas due to the convenience of Hong Kong's financial center. There have been precedents of this, with the UK discovering 30,000 companies with the same names as Chinese companies, all operated by Chinese nationals, and most of these companies were inactive. Moreover, it's not just about having money, but also connections. Some corrupt officials have been found bribing customs authorities to transfer funds under the guise of national security. One of the most famous cases involves Ma Jian, the former vice minister of state security, who allegedly laundered money for corrupt officials and financial executives. Another method for Chinese nationals to transfer funds is by opening bank accounts in Hong Kong and using them to purchase insurance products similar to bank certificates of deposit. According to data from the Hong Kong Insurance Authority, spending on new policies by mainland visitors to Hong Kong increased by 21.3% in the first half of this year compared to the first half of 2019. During the pandemic, such sales were almost non-existent. Lastly, there is the method of smuggling gold. With high gold prices in China, some unprincipled traders attempt to profit from price differences by smuggling gold. They disguise gold chains as handbag straps to pass through customs undetected. For instance, at Guangzhou Baiyun Airport, a passenger was caught trying to smuggle gold chains worth $77,000 by disguising them as handbag straps. At the same time, another passenger was caught smuggling 2 gold chains with the weight of 799 grams, valued at approximately 590,000 yuan, or about $80,000. This incident illustrates the high risks involved in such smuggling attempts. Next, let's discuss whether the Chinese government is allowing the outflow of funds without any countermeasures. The government has indeed increased efforts to crack down on underground banks, financial institutions involved in illegal currency exchange, and gambling tours to Macau. Wealth in China is often tied to real estate, making it difficult to liquidate assets. However, cryptocurrencies have outpaced regulatory measures and technological controls, allowing many to become rich overnight and then lose it just as quickly. On January 14, 2022, the State Administration of Foreign Exchange of China reported on 10 cases involving underground bank transactions, targeting illegal foreign exchange trading through underground banks. Criminal groups involved in gambling and tax evasion often collude with underground banks, forming a chain of illegal activities. The 10 cases reported involved 2 companies and 8 individuals penalized by the Foreign Exchange Bureau between 2020 and 2021. The highest fine was imposed on a Yunnan native, Mr. Zhuo, for illegal foreign exchange transactions. From August 2018 to November 2019, Mr. Zhuo conducted 30 illegal foreign exchange transactions through underground banks, totaling $10.8 million. According to Article 45 of the Foreign Exchange Administration regulations, he was fined 7.4 million yuan, the highest fine ever imposed on underground bank activities in China. In December 2023, the China Banking and Insurance Regulatory Commission and the People's Bank of China imposed significant fines on several financial institutions for illegal activities. Among them, China CITIC Bank was fined 225 million yuan, or $28 million for violations, including issuing a large number of loans to cover bad debts, providing credit to non-financial guarantee companies, and conducting some operations that did not comply with national policy requirements. Additionally, illegal currency exchange services that once allowed the exchange of yuan for foreign currencies in cities like Shanghai and Shenzhen were shut down by police 8 years ago. Regulatory authorities have also closed almost all gambling tours to Macau, a separately administered region of China. Gambling tours once allowed wealthy Chinese to buy chips with yuan, use some for baccarat or roulette, and convert the rest into dollars for withdrawal. In recent years, central banks worldwide have aggressively raised interest rates, causing a sharp decline in cryptocurrency values. Bitcoin fell below the $20,000 mark, significantly impacting Chinese tycoon Zhao Changpeng, founder of Binance, the world's largest cryptocurrency exchange. Zhao's net worth shrank to $10.2 billion, a nearly 90% reduction. According to the Bloomberg Billionaires Index, in November 2021, Bitcoin reached an all-time high of nearly $69,000, and 7 billionaires associated with cryptocurrencies had a combined net worth of $145 billion. By June 15, 2022, their collective wealth had evaporated by about $114 billion, a loss of over 78%. Zhao Changpeng suffered the most significant losses. In November 2021, Forbes estimated Zhao Changpeng's net worth at $90 billion, surpassing the 62.3 billion yuan wealth of Nongfu Spring founder Zhong Shanshan, making Zhao the richest person in China. However, Zhao's net worth has since plummeted nearly 89% to $10.2 billion. Some netizens jokingly refer to this as overnight poverty. The Daily Economic News speculated that the total market value of cryptocurrencies is now about $900 billion, down from the $3 trillion in November. This means the cryptocurrency market lost $2.1 trillion in just 7 months, nearly equivalent to the market value of Apple. Despite these measures to control capital outflows, foreign investment began withdrawing from China following the onset of the U.S.-China trade war, a trend accelerated by the pandemic. This has led to a significant reduction in orders, capacity relocation, and stock market divestments, causing investors to lose confidence. Some netizens have expressed on Twitter that these measures fail to restrain the privileged class, claiming all regulations are only meant to restrict ordinary people and Chinese CCP laws only target the common folk, while the privileged class is above the law.